Uh, Hello traders and investors, it's Trader here. Uh, as you all know, the stock market offers us an opportunity to make money. So a lot of people are attracted to the market because of that. But there are some things that you need to be aware of before you can expect to make money from the stock market. And today I want us to discuss some of those things that will help you to become a consistently profitable trader or investor. Okay, so what you need basically before you start investing or trading is that you need to have a trading plan. In this video, we're just gonna refer to it as a trading plan, but it's the same principle. It's applicable if you are approaching the market using the investment approach, right? So basically, you need to have a trading plan. That's the only thing that will give you a chance to succeed in the market. And a trading plan, it's not something that is complicated. It's just something so simple. So a trading plan consists of three different components. So the first component is the approach that you'll be using to trade the market. The second component is risk management. Then the final component is the trader's mindset, your psychology. So now we'll discuss those three components in brief. So in the first component, we said that it's the trading strategy or the trading approach that you are using. There are two different ways you can approach the market, or we'll just discuss two. The first one is fundamental analysis. Some people, they call it value investing. We have a video where we reviewed a book on value investing. You can check that video. We will just put a link to that video. So with fundamental analysis, that is whereby you pay more attention into the financial statements of the company, and you analyze the business itself, and you analyze the management. So in this approach, the trader focuses more on the company. What are the chances that this company is going to be profitable in the near future before they make a trading decision? So yeah, the value investing, some people, they call it value investing, fundamental analysis. Some people, they call it value investing. And as we said, we do have a video whereby we talk about value investing. And Warren Buffett is like the face of value investing. His mentor, Benjamin Graham, wrote the book The Intelligent Investor. A lot of investors have already read this book. If you haven't read this book, just check in the description. We have a link so that you can grab yourself a copy of this book. So yeah, with fundamental analysis, you look at the company financial statements, you look at the cash that the company is generating, and you try to determine the possibility of the company continuing to generate that cash flow in the future, and what business the company is involved on, what product the business has that gives them an advantage over the other companies that they are competing with, right? So that is a fundamental analysis. The other approach is technical analysis. So technical analysis, that is where the trader uses a chart. Basically, technical analysis, it's a price volume analysis. Other people, they call it a price action. There, whenever you look at the chart, you are trying to find some repeatable patterns in the chart. So you try to exploit those repeatable patterns. For example, there is a pattern called a cup and handle. So that's a bullish pattern. So you look at different charts trying to identify a cup and a handle. So when you spot the cup and handle, then that will give you an idea what is supposed to happen, because the market itself, everything that happens in the market doesn't change. The companies will change, the management of the companies will change, the products will change, but the human behavior of market participants won't change. For instance, if personally I see something that looks like a bullish signal, I will plot a trend line waiting for that bullish signal to break in a certain direction. If it does, then I will take a trade and hold that position until my profit target is hit or until my stop loss is hit. So if there are many other market participants who are looking at that company, who are looking at that bullish pattern, most of those traders, they will take a similar trade. So that is why if you're using technical analysis or price action of the chart, of the company, then you are looking to exploit those repeatable patterns. The difference between technical analysis and fundamental analysis is that in fundamental analysis, your focal point is the business itself and the stories around that business. But when it comes to technical analysis, your focal point is on price action. You are looking at price. Yes, that won't stop you from knowing any other things around the business. For instance, if you're investing in Apple, you know that Apple produces iPhones and Macs. You know that the CEO is Tim Cook, so it's easy to know those things, but those are not your focal points. It's like knowledge that you have in your mind. And then finally, you can combine these two approaches, technical analysis and fundamental analysis. And just something that was missing on technical analysis, there are two ways to do technical analysis. There is a predictive approach and then there is a reactive approach. There are people who use Elliott wave theory. Elliott wave theory is more of a predictive approach. Basically, you have to know the Fibonacci retracement and stuff. So if the first move, the major move, go up by a certain percentage, when it starts to retrace, you expect it to go down by a certain percentage, because now you know you can plot a Fibonacci of that specific move. Then you will have different percentages where you expect the price to find support. Then you can sell at the top because you're expecting the price to drop, and then at that set percentage you will expect the price to find support and then continue to trade higher. And also when it trades higher, it will trade higher by a specific percentage move compared to the previous move. So that one is more of a predictive technical analysis. Then there is reactive technical analysis. For instance, if you are using moving averages, you will probably say that you are waiting for the price to cross a certain moving average. So until the price has crossed the moving average, you just have to sit in your hands because your conditions are not met. So that was the difference between predictive analysis and technical analysis. I would imagine that everything that concerns fundamental analysis is more of a predictive analysis, because yes, you can know based on the recent result how the company has performed, and also maybe based on the communication of the executives or the CEO, the chairperson, saying what they're planning to do with the company as they go in future. Then you can sort of predict what are the chances that the company is going to be profitable and such. So I imagine that fundamental analysis is more predictive rather than reactive. Okay, and then now there's nothing that is stopping you from combining these two kinds of approach, the technical analysis and fundamental analysis. In fact, there is a trader so many years ago, around the 1960s, Nicholas Davas. So Nicholas Davas, in his book How I Made $2 Million in the Stock Market, at some point he mentions that he's a techno-fundamentalist, meaning that he combines fundamental analysis and technical analysis to do his trading decisions. So there are many people who use both the chart and financial statement of fundamental analysis. Then they combine the two to get whatever information that they want. It doesn't matter which approach you choose. Whatever approach that you choose, it's better to stick to it, because if you keep on jumping from one approach to another approach, then you're going to have inconsistent result. So yeah, that's the first component of a trading plan, is that you need to have a trading approach, and there are two kinds of trading approach. One is fundamental analysis, one is technical analysis, and then you can combine the two to do a techno-fundamental analysis. Then The second component of a trading plan is risk management. So risk management can be combined together with money management. Whenever you place a trade, you need to know where you are going to be wrong. That is saying, if we are to use technical analysis as an example, you buy a share that is trading at 100 rand per share. Then you expect that share price to rise. Then before you place the trade, you need to know that, okay, what will happen if the share price drops? Then you need to determine your exit point. For instance, you can decide that if the share price drops to 90 rand, then you will just cover that position and then look for another opportunity. So that is risk management. As we mentioned in the previous video, that risk is the possibility of a loss. So risk management and money management, those are the ways of minimizing the loss that you can incur in the market. Then there's this thing, most people will recommend that you don't risk more than 2% of your capital in a single position. That is to say, if you buy something that is trading at 100 rand per share and the stop loss it's minus 90 rand, or it's 90 rand per share, meaning that you'll be losing 10 rand in that position. So based on the total value of your portfolio, let's say it's 50,000 rand, then 2% of your 50,000 rand, it's 1,000 rand. And then you will take 1,000 rand divided by 10 rand, which is the amount that you are going to lose if you exit your position at 90 rand. Then you will find the number of shares that you're supposed to buy so that you don't lose more than 1,000 rand in that position. So it's important to know your risk tolerance and also to determine how much are you willing to lose. Personally, I don't recommend risking more than 2% because there's this thing, a table of risk of ruin, meaning that if a single trade is a risk of 2%, how many trades can you take so that you lose a certain percentage of your total portfolio? For instance, if the risk on each position is 2%, then if you take 5 positions at the same time, different companies, each company you risk 2% per share. Then if all those trades, they become losses, then you will lose 10% of your portfolio. So the table of risk of ruin tells you that if you lose 10% of your overall capital, you need to make back from the market about 11.11% just to break even. That is not to make money. So if you lose 25%, 20% of your capital, you need to return 25% to break even. If you lose 50% of your capital, then you need 100% just to break even. So you see, if you don't minimize your losses, it's emotionally draining to try and win back the money that you have lost. And I mean, if you can lose 20%, it will be challenging for you to try and just to break even. You can see there in the description, I have a link to a blog that I've written. At some point, I once lost 20% of my capital, even though for that year I managed to return 5%. So I had to return over 30%, I had to return about 28% just to break even. Then the additional 5% or so is what I returned as a profit for that year. So at any time, per position, you should not risk more than 2%. The less you risk, the better. But the total combined risk, personally, I don't want it to exceed 15%, because if it exceeds 15%, or if I lose 15% of my capital, I need to return at least 18% just to break even. Like I said, it's emotionally draining to try and do that. And then for the people that use fundamental analysis, they might not use a stop level, or maybe your platform does not allow you to use a stop level. But first, let's address how do you manage risk using fundamental analysis. I know that there are people who try to determine the intrinsic value of a share. Then they look at the current trading share price. So basically, if the intrinsic value of that stock is below that trading price, it gives them a room of error or a margin of safety. So I would imagine that then if the price continue to drop lower, they will probably exit, because you can't say that now the share is giving you more margin of safety. But there are ways that fundamental analysts try to minimize and handle risk. So, like I said, margin of safety is one way that they do it, and also by doing their research, looking at the company statements, they are trying to minimize the losses. And then now, if you combine the trading strategy and risk management or money management, then this is what we can call a strategy: the approach plus risk and management. A combination of these two, it's supposed to have a positive expectation. A positive expectation is something like a statistical analysis of your trading plan. If you had to take 10 trades, how many of your trades are going to be profitable? And then that will give you the win rate of your approach. Then we also need to look at the size of your losses versus the size of your profit. Most of the time, I try to take trades that have a risk to reward of 1:3, meaning that if I'm risking 10 rand per share, I should at least, if I'm correct, I should at least get 30 rand per share. So that's what gives me a risk to reward of 1:3. With that risk to reward, I need to be right 3 times, or 3 out of 10, just to make money. I will make an example to show you that, okay, if you were to take 10 trades, the first 3 are 30% return, now you are sitting at 90% return. Then the next 7 trades are minus 10% losses. In the end, you are left with positive 20%. Well, it is as simple as that. So you see, I can be wrong 7 times and only be right 3 times, but I'm still able to make at least 10 times or 2 times the risk that I've taken, which is equivalent to 20%. We won't do proper arithmetic, but just to give you an idea, the assumption is that each reward is 30 rand and then each loss is 10 rand. So 3 times 30 rand, that's 90 rand. If the other 7 trades are losses, then it's minus 70 rand. Then the difference is positive 20 rand. So you see, now that approach has a positive expectation, meaning that your approach has an edge. So those are the first 2 important components. And for most people, that's all that they need to know in order to know that they are profitable or not. Then now let's go to the third and final component, which is the trader's mindset, the psychology of you as a trader or as an investor. In the beginning, you might think that, okay, you have a profitable strategy, you can manage risk and stuff, and then you think that you are okay, now you can trade. But if your mind is not there yet, if you haven't adopted the mindset of a winner, or in trading, there's this thing that they call a probabilistic mindset, meaning that you understand that the market, it's not guaranteed that something is going to happen. You just look at the different probabilities. One thing is more likely to happen over the other. Once you reach that level, knowing that nothing is guaranteed in the market, it's just a game of probabilities, then it would be easier for you to be able to accept your losses. And if you have a losing streak, you don't panic, you don't change your trading strategy so that you look into another trading strategy. Or even like we saw in the past weeks, the bitcoins or cryptocurrency had a bit of a challenge. They were trading lower. The index that we use in South Africa to track cryptocurrency, EC10, was also falling. So all the traders who have adopted a trader's mindset, who are confident in their approach, they didn't panic. Some bought more, but those who didn't even buy more, they didn't panic, because they understand that the market, it will just go up and down from time to time. So that is what you need. Basically, you need to have mental strength. And also in the description, we have a link to a book that will help you, just in case you still haven't adopted this winner's mindset and you're still not thinking in probabilities when it comes to the stock market. You can look for that book. It's available on Amazon. It will help you. Personally, it helped me a lot when I read that book, because then I found the missing key to my puzzle. Already the trading strategy and my risk management was in place, but I was still emotionally attached to my trades. If I were losing money, I would be upset. If I were making money, I would be excited. I'm not saying that you should be emotionless when it comes to trading, but you need to be able to control your emotions so that when you make money, yes, you expect to make money because you have the skill and experience. But when you lose money, you should be at peace, because before you took the trade, you made peace that, okay, fine, if this trade goes south, then I will cover my position and get that loss as the outcome. So yes, you need all these three components. Number one, you need to have an approach, which can be technical or fundamental analysis, or a combination of technical and fundamental analysis. Number two, you need the risk and money management, so that you know when are you going to exit your trades, if you are making money or if you are losing money. And then finally, you need to have that mindset of a winning trader. Once you have all those three things, you will have a combination which you can call your holy grail of winning in the market. So that's what I wanted to share with you today, so that you also grow as a trader or as an investor. Because yes, it's nice, it's exciting to open a trading account or an investing account and to go and look for companies that you want to invest on and everything. So before you do that, just have a plan, because without a plan, you are less likely to succeed. But I mean, we know that there are people who like to take shortcuts. It's life, we are human beings, so sometimes it's easy to take the easy road. But at the end of the day, once you start to get a disappointing result, just stop, ask yourself if you have a complete trading plan uh, before you embark on that trading journey. If you don't have a trading plan, just don't rush into buying stocks and everything that is available on the market. Just stop, research on the different approaches that are available, find an approach that is suitable for you, that you are comfortable with using, see how you can manage risk in your investing or trading journey. Once you have all these two components, then now you have to work on your mindset to tell yourself that you are capable, you can do it, you can make money from the market, you are comfortable with the risk that you are taking, you understand your risk appetite, your financial needs, everything that will affect you mentally. Just make sure that you iron that out before you go and place your first trade. Then once all of that is sorted, then you will make some money. So that's it, what I wanted to share with you today. If I missed something in terms of the whole trading plan, just let me know in the comment section. And once again, if you find value in this series of videos, please click the subscribe button and smash that like button, so that more people can see the content of this channel. Thank you.